This is Notorious POD, the podcast for the best informed people in the real estate industry. Rob Hahn is your host, and Notorious is where the real estate industry comes for real talk with no bullshit.
Hello, everyone, and welcome to Musings. This one's kind of funny. I guess I'll call it Musings, but I think it's almost better off thinking of it as crazy brainstorming. As some of you know, maybe I'm assuming anyone who's watching me or listening to me likely watches or listens to industry relations. So if you know, the last episode that just went out today, I think this is Wednesday, saw that Greg and I had a conversation with Saul Klein talking about the Black Knight acquisition by Intercontinental Exchange, or ICE. I think it's kind of cool that they could be Black Ice, right? I mean, all right. But one of the big things that I think Saul was talking about was that ICE would like to create some sort of a futures market in mortgages, because Black Knight is obviously a big player in mortgage tech. ICE is a major player in sort of commodities and stocks, bonds, like they're just a big financial trading platform. So, okay, we talked about it, and I think I just didn't really see how that worked, or, whether Black Knight was really even necessary or whatnot. But it was an interesting conversation. So keep that, like, that happened, right? So I've been thinking about futures, and then a couple of weeks ago, I know I spoke to Kevin Oakley, who does the podcast around sort of new construction and look at the builders market. And the final piece, I guess, is the fact that I've been, obviously writing about and talking about Open Door quite a bit. So here's kind of the crazy thing that I would just want to think about, brainstorm, and just, I'm sure it doesn't happen. There must be a bunch of reasons, but what the hell, let's have some fun. Let's talk about it. So here's the idea. The idea is, is it possible now to create a housing futures market, or maybe broadly speaking, housing derivatives market? Okay. So first of all, obviously I'm not a CFA, I'm not an investment banker. I don't work in finance. So I have to, refer to, sort of more expert sources. So let's start with this. All right. So this is from the Coffee Guide. So first of all, commodities futures has been around forever, right? I think you could almost say it's probably the first derivative, and it serves a very particular and useful function. Excuse me. So really, I think, if you went and looked at history, the way it came about essentially is the problem that farmers have, right? So if you're a farmer, you plant in the spring, and you have no choice. You have to wait months, right, for whatever crop to grow, and then you sell in the fall after harvest. And the problem you have as a farmer is, when you're planting a certain amount of wheat or whatever, thinking, okay, what's the price of wheat? How much am I going to get? And your big problem is, what happens when harvest season comes around and the price of wheat is way below what you thought it was going to be, bountiful harvest, whatever, right? So you want to hedge against that. You want to just have some certainty so you can go to sleep at night. So futures come along, and the idea is, you would say to a baker, who needs a bunch of wheat to make bread, hey, I will sell you wheat when it comes, when it's harvest time, and they agree on a price for the future, right? Hence futures contract. So I think in the original sort of how it came about, it's just normal, economics, normal business. Like, I'm a farmer, I would like to get $10 a bushel for my wheat. Baker's like, okay, I know that if I had $10 wheat, I could bake bread and sell it for this. So that's fine. That works for me. We agree. When you harvest, I will pay you $10 a bushel. The farmer's like, great. At $10 a bushel, I can make plans. I could spend this much on seed. I could spend this much on labor, whatever it is. I can plant this much wheat. So it allows that whole thing to work. Once you set that up, obviously, then you have intermediaries. basically financiers who come in and say, you know what, I want to take on that risk, right? Because on the flip side, let's say wheat prices plummet, then the baker's lost, right? Money is like, well, I didn't need to pay $10 a bushel. Um, or if the prices went, I don't know, like there's a lot of risk, that's related to that. So you have companies, you have individuals come and say, listen, here's what I'm going to do. I want to be in between you two and take on that risk. So, hey, farmer, you want $10 a bushel? I'm willing to pay you $10 a bushel. If the price of wheat goes to $5 a bushel, then I've lost a bunch of money, right? On the other hand, if the price of wheat goes to 15, then I've made money, right? Because I could sell it in the spot market, after harvest for $15. Because there are going to be some people, some bakers, some whoever says, oh, we need some wheat. What's wheat right now? It's $15. All right, cool. Buy some wheat. So that's kind of the evolution of the market. So looking at coffee, because obviously coffee is a commodity. For me, it's a very important commodity because, God damn it, I'm addicted to this stuff. But this is how it works, right? So, it's real simple, straightforward to some extent. A trader comes in, buys futures contracts, goes to a coffee grower, right? Hey, I want to buy coffee at this price. And they come to some agreement. And presumably there's some fee that's paid, so you bought, okay, I can buy whatever ton of coffee at, I have no idea what the current prices are, right? Whatever it is, right? And then talks about traders who can sell short, but we're going to skip over that. This is the part that I found the most interesting down here. What it says, the clearinghouse, excuse me, guarantees the performance of both sides of all open contracts. So each trader only deals with the clearinghouse, right? So if you are a coffee roaster, right, you don't go to some coffee farmer. I mean, maybe now you do because you've got whatever, real high end, like bespoke coffee and organic and free trade. Who knows, right? But chances are they're going to a clearinghouse, some centralized entity, and say, hey, I want to buy some Colombian coffee. How much, right? And maybe they don't know exactly what the demand is going to be. So they're going to buy on the spot market. Hey, I need some coffee. How much? I need some coffee. How much? On the other end, you have coffee growers who say, I want to do futures, right? So they're going to come into the market, or they'll hire a trader or whatever, and they'll say, hey, I'll sell you coffee futures for X dollars a pound, right? And then that trader goes to the clearinghouse. Clearinghouse says, cool, if you want to buy it, whatever, you sold it at this price, I'll buy it at that price. It matches the other side, right? Okay. So here's what it got me kind of thinking. Again, because Saul Klein, we're talking about futures and what would this work? I knew for a long time that Open Door had a program with new construction, with builders. And I think Lennar, this is the slide, I think Lennar is a big investor in Open Door as well. And their whole program has been this notion of trade up, right? So the idea is you go to Lennar, you go to a builder, you look for a home. You look at the floor plans, you do the tour, and the builder's like, yeah, this building will be completed in September, right? It is now April. You say, I love it. I put down a deposit, I buy it. But that whole process, now I have to think about selling my house, all that. What Open Door is saying is, listen, we want to be in between you guys. So we are going to buy your current home, and then you can be assured to buy the Lennar home, right? And this whole unlock the buying power, no showings required, move on your schedule, sell it safely, etc. And for new construction specifically, this was really useful from what I understand. I've never used this program, but if I were, I think it would be really useful because, again, if you're the buyer / seller, what is it you want to do? You want to move into your new home the minute it's ready. Lennar is building it. You love that home. You bought it. You spec'd it out. Your issue is going to be, okay, but I have to sell my home. The timing, because if I put my home on the market now, it's April, it's spring selling season, it's May, but the Lennar home's not, ready until October or September. What do you do, right? You can't really put on the market today. So you have to put it on the market closer to the time. But then if it sits on the market, then you've got all kinds of problems. You don't want to pay 2 mortgages. There's a lot of problems that are associated with timing that. What Open Door said is, listen, we will solve that problem. And obviously Open Door is going to make some money on whatever spread. What occurred to me about this was this felt a lot like a futures contract, right? So in effect, the seller is almost doing it, but not a futures, like the seller's almost doing like a put option, right? Saying, hey, Open Door, I'm going to sell you this house. In fact, I've sold you this house, but I'm not moving. I'm not leaving until my new home is ready from Lennar, right? And presumably Lennar's like, okay, we want to sell this house. This gets it done. Great, Open Door, we'll hook you up. So that's kind of, in a way, solving the timing problem that I felt like coffee farmers have, right? So what if it went to that level? What if it were an actual futures, a contract? So I'm trying to imagine, and it seems to me there's nothing. I'm probably not understanding all of the intricate details. So I wish Kevin Oakley were available. I would love to kind of get his thoughts. Kevin, if you're watching this, I'm calling you out. Would a builder accept that? It feels to me like they would, right? Because a builder goes in, they get a construction loan. Think about what a builder has to do. They buy the land, they get the permits, they do all of that. And they say, okay, I'm going to build whatever, 100 homes here, or I'm going to build a dozen. Say it's a smaller builder, custom builder. I'm going to build a dozen homes here. And I would like to get this price for it. If Open Door came to them and said, fine, we will do what is effectively a futures contract, right? So we will put down a deposit, and when you're ready, when the home is built, we will buy those homes from you at the price we agreed on back in May, right? From the builder standpoint, it seems like that will work because they have that certainty, right? Now, they're not going to take, in the upside. So there'll be negotiations. And look, home prices are going up 15% a year. So by the time we deliver, whatever, right? But whatever their price is, if the builder's getting the price that he wants, it should work for him to sell to Open Door effectively, or to somebody else, essentially a futures trader, at that price. So they would promise to deliver 10 homes, 12 homes, whatever, at 500,000 each, whatever it is, right? Okay. Then you have a futures position. Open Door is like, cool, here's a deposit, here's a margin payment, whatever, 5%, 10%. And I now have a futures contract to take delivery of your 10 or 12 homes when you are finished building them, okay? On the other side of this transaction then would be buyers. Could a buyer then come in and say, okay, I see you have futures contracts, right? Like you are going to take delivery of these 10, 12 homes in September. I would like to lock in a price right now, right? So I guess that's not really a future. It's not a long and short in a sense. It's more like a long and an option, like a call option, right? Again, if I'm Open Door, I say, okay, I think price is going to do this, but there's risk. Rates are going up. Maybe it's not going to go up as much. Maybe home price will actually fall. Who the hell knows? Would Open Door then be willing to say, okay, do a bunch of finance, but bunch of complicated math, Black-Scholes theorem, the whole thing, and sort of say, yeah, we will sell you that option on this home that the builder has contracted to deliver to us, and you can buy it at this price, right? In my mind, it feels like that should work, right? Again, there's a lot of finance. There's probably a bunch of regulations. Does the home buyer, presumably they would have to qualify for a mortgage unless they're very rich or whatever. But there's the core idea essentially being remove the risk for the builder and then remove the risk for the home buyer, right? And there has to be a way for that clearinghouse, meaning Open Door, to make that work, right? And get some margin out of it, get a spread, whatever it is. Maybe if it's an option, then just charge for the option, and then you exercise the option at whatever price. What would this do? I mean, the reason why I think this could be interesting, and somebody ought to investigate it, is it could lead to sort of the first-time home buyers. I'm going to have another video coming because, my last musings was really talking about millennials and a dream of home ownership and how we're locking people out. I'm trying to imagine the possibility of a young couple saying, you know what, we're not ready to buy today, but we really would like to buy a year from today. Could someone like that go to a clearinghouse? And I'm going to call it Open Door for now. But if you think about it, it really could be any company with a really like a lot of money with a very strong balance sheet, right? And essentially buy an option, right, to purchase a home at some point in the future, a year from now, 2 years, whatever it is, right? Um, Obviously, the further out you go, the chances are the option price is going to be higher. That's complicated math, but it seems like it should be doable, right? Um, would that then? I mean, I feel so. Here's why I'm thinking this could be cool. I feel like that is different than a young couple, say they're 30 something, they're like, oh, we're gonna have a baby, we should buy a house, right? And then saying, okay, well, we have to save up for down payment, we have to qualify for mortgage, it gets all this stuff, versus, hey, we think we're gonna want to be homeowners. Like we just got married, we think we're gonna want to own a home 3 years from now, 4 years from now, 5 years from now. Let's go buy an option, right? From Open Door. And Open Door says this option means we will sell you a house like this in this new development for this price, right? You've like essentially locked the price. Would that then potentially create a different type of mindset, different type of goal? In other words, that couple now is like, okay, we have effectively the American dream is not out of reach anymore, right? Like we have an option to purchase this house at 500,000, which right now we think we can afford. In order to hit that, we have to save this much money for down payment. We have to go get this type of mortgage, but you've got 3 years, right? And then from Open Door standpoint, it's like, okay, we know we're going to take delivery. We go do a deal with the builder. When are these houses coming out of the ground? It's over a 3-year period. We can make this work. Let's go do a futures contract, right? And then one of those homes we're going to take delivery from 3 years from now, we're going to sell to this buyer, this couple that has a call option. I know it's complicated. It sounds crazy. And as I'm talking about it, I'm like, it sounds crazy, but why not? And we have like so much complex, like really sophisticated derivatives in commodities, in financials, equities, bonds, like crypto, all other asset classes. And I know one of the reasons why we maybe don't have it in real estate is because it's not a commodity. Right? Like we know that. This is why iBuying is such a phenomenal, fascinating thing. It's not a commodity. At the same time, isn't there some way that we could figure out, especially with technology, as companies like Open Door and others are really advancing, to try and put this into place? All right. Obviously, I'm not a finance guy. I'm not a banker. I'm not a trader. I'm not a CFA, but I know a bunch of people who are. I'm going to start asking them, how could something like this happen? Like, is there a way to leverage derivatives, whether that be futures or options or some other type of derivative, to create more liquidity, more opportunity for younger families to lock in their American dream earlier, right? We already know that mortgages, a number of mortgage companies will let you kind of lock in a rate, right? I think when we bought this, we locked in our rate for, I think it was like 30 days, 60 days. So the challenge here is locking in a rate or locking something in way longer in advance. I'm not sure if that's doable. You guys, if you know, then tell me like what the difficulty or the challenges are. But it feels like there's something there, right? It feels to me like there's got to be something there. So what are the components? I don't know if this works for existing homes. In other words, like a homeowner in a house doing like a futures contract. I mean, maybe I that feels a little off to me versus a new construction, a builder. Because again, a builder to me is more like a farmer, right? You've decided you're going to build whatever 100 homes. You know you have these types of margin requirements. You know you need to make this much money. So if somebody comes along and says, okay, we will guarantee we're going to buy at that price, right? We're going to lock it in. They benefit, they win if home prices are above whatever the builder and whatever the futures contract says. They lose if home prices are below that, but that's what they're getting paid for, right? because what they're betting is effectively that home price will be more than what they just paid in futures. For the builder, this has to work for them, right? I mean, they have certainty. They know exactly, okay, we are going to spend whatever, $50 million building this community with 150 homes. Here's a futures contract that says they're going to pay us $75 million for these, so that I have margin, so I have guaranteed profit. Certainty, I can go do what I need to do. And then that company, so again, call it Open Door as the clearinghouse, the trader, who has the futures contract, now has to figure out, how do we sell these off, right? So we don't get stuck with 150 homes, right, that we can't sell. Now, they could lose money. That could happen because maybe prices didn't go up as much or whatever the situation, but that's the risk and that's what they're getting paid for. On the other hand, they could win real big if real estate prices go way up, right? And I think there are finance guys who are real smart and they could figure out how to price that risk, right? Then the missing piece is for the consumer piece, right? Because the thing, I guess, why do I care? Part of it, obviously, is because I want those young homeowners, young couples to be able to buy homes. I want them to be able to achieve an American dream. The other part is, if it's not this, then the direction that the industry is headed in right now is a lot of like this build to rent, because it serves a similar function, right? Big hedge fund, big private equity fund goes to a build 150 homes. We will buy the entire thing from you for whatever, $75 million. You are guaranteed your return. We then will rent it out and turn it into rentals and so on and so forth. So I guess I'm just trying to figure out, is there a way for them to, instead of turning it into rentals, simply turning it into almost like retail sales, right? And use leveraging derivatives, leveraging option contracts, leveraging things like that. And to what extent, maybe they say, we'll just take the risk. We'll just go on the spot market. We'll just start selling them off on ourselves because we bought it at this price. We now know we can sell it at this price. Feels like there's something there, right? And it's not the same sort of we buy ugly houses, iBuying type of thing. But at heart, it's still similar, right? Because you're reducing uncertainty. You're removing risk from the builder, and you're getting paid for it. So, and again, maybe that's exactly how this program works right here. I don't know, but it doesn't feel that way because there's this whole enter your home address and, there's sort of a trade up type concept. Whereas what I'm talking about potentially works for first time home buyers, right? Where by leveraging futures contracts, you go to a builder, you buy out the entire inventory or a big chunk of it. If they're building 150, you say, I'll buy 50 homes. Give me a futures contract for 50 of those units, and then I'll take the risk on the spot market. Or if I'm already taking that risk, I already have the right to purchase, I'm going to start writing options contracts on those homes. Anyway, I told you this is less of a musings and more of a crazy brainstorm. But if you've listened through all of this, let me know. What do you think? I know a number of you guys are finance guys. I know some of you are new home construction. A lot of you are realtors. You have a lot of experience with things like new construction. Could something like this work? What would be required? And if it can't work, why wouldn't it work? I mean, is it just too much risk? Is it because they're not commodities? What's the deal? Why wouldn't something like this work? I'm just real curious, right? Hopefully that was entertaining for you to listen to as it was for me to just brainstorm and brain dump. All right. Thanks very much, everyone.